Looks like we have a few who just joined us. We'll get started here in a few seconds. Okay. Well, hello, everyone. So my name is Zach Strobel. I work with NKU's Center for Innovation and Entrepreneurship. And we're partnering with Barnes Dennig through our Entrepreneurship through Acquisition program. And what we do is we provide all the essential elements needed to prepare for, acquire, and grow a small business. Welcome to part 3 of a masterclass with M&A game changer, Dino Lucarelli. Just a couple reminders: if you are going for the CPE credit, make sure that you fill out the poll questions that will pop up. We will provide some information in the chat to make sure that your pop-up blockers are disabled so you can answer those. And then as you have questions going on throughout the seminar, make sure that you type them into the chat and Dino will answer those. And with that said, I'm going to go ahead and turn it over to our speaker, Dino Lucarelli.
Okay, well, thank you, Zach, and welcome everyone to our 3rd of 6 sessions on how to buy and sell a company. A little bit of my background is I'm a director at Barnes Dennig. I lead the Transaction Advisory Services group. And essentially what we do is help people buy and sell companies. We do valuations for them. We help them with the due diligence process. We help them with tax strategies. So my group we are the deal makers, and we're partnering with NKU in this program. My background prior to Barnes Dennig was I led my own company, and we did this very work for about 15 years, from 03 to 18. Prior to that, I was public company CFO in a couple of companies. And prior to that, I worked in Federated Department Stores Treasury Department, and I assisted with our merger and acquisition processes. So with that, a couple of housekeeping items to remember: the CPE, there will be polling questions throughout the session. Please answer those. They'll come up about every 15 minutes. Please answer those questions so that you can get credit. So today, the topic is the cost of capital. Next week, we'll be talking about business valuations. The following week, we'll talk about how to finance an acquisition. And then our final session will be the due diligence process. So this session will be like the others, some lecture and accompanied by questions and answers. I invite you to type in any questions you have into the chat box on Zoom, and those will hopefully pop up on my screen so that I can address those questions. We've muted everybody, so please use the chat box. You won't have any audio. Okay, what I would say about this session, the cost of capital, is this is going to be a bumpy ride. When I teach this in the MBA program, it takes probably 9 hours, 3 sessions with MBAs who are studying, looking at textbooks to get through this material. And that matters because we're going to have to go fast, and I'll touch on a lot of the concepts. What I would say is that, this is to professionals. So most of you have heard a lot of this before. This will be, if nothing else, a very strong refresher of things that you've already learned and just, put way back in the back of your brain because it's been maybe a number of years since you've touched it. So feel free to ask questions. So when we talk about cost of capital, what we really mean is what's our expected return as business owners so that we can pay our interest on our debt and we can get a return as an equity holder, as a shareholder. So that's a long-winded way of saying cost of capital. So when we think of cost of capital, what we really should think of is what's my expected return on invested capital. So that's the first thing. I think it's real important to understand that. Interestingly, I was talking to somebody just last week, and we were discussing the business valuation and their cost of capital. And the owner said to me, which is not uncommon, well, I don't have a cost of equity. I just have my debt. I have interest on my debt. Well, look at it this way. If you went into business and the only amount of money that you had from operations at the end of a year was enough to cover your interest and principal on your debt, would you consider that to be a successful business enterprise? And of course, the answer is no. There is an implicit cost of equity that you as a business owner expect for the time and energy and money you spend. And if you have other investors, that they expect. So think about it. If somebody invests in your business, they don't expect that all you can do is service your debt. They expect that you can give them a return. Now, what is their return? Well, there are ways to calculate it. And today we're going to go through some of the complexities and the formulas and the algorithms that we use to calculate that cost of equity and to try to make it make sense to us in the context of buying or selling a business. So when we measure this, we do it so that we can understand what our goals and objectives are, not just for buying or selling a company, but we should also consider our cost of capital when we do our annual business plan. So if you do an annual business plan and let's say we're targeting 10% pre-tax income, 10% of sales. Do you know if that covers your cost of debt and your cost of equity? Now, in a public company, for instance, if you target 10% and that gives the debt holders their interest and gives the equity holders a 3% appreciation on their money, are they happy? Chances are they're not. The stock market over the last 90 years has returned somewhere between 12 and 14% annually to shareholders. So that's a starting point for what a business owner should expect from an equity investment. Except when you invest in a small company versus a large public company, you can understand that you're taking on more risk than the buyers of stock in, say, Apple or Exxon. Because those companies are large, they have all kinds of safeguards in place. They have strong, robust financial reporting processes. They have strong repeat business. They have a very strong marketing and IT infrastructure. They have all of the things that large, successful companies have. But when we invest in small private companies, very often you don't have those same principles or conditions. So in the absence of all of the things that public companies have, small private companies are perceived to have higher risk. We as investors are pretty smart about understanding for a higher risk, I should get a higher return. So if I expect a 12 to 14% return in public securities, public equities, then I should expect de facto a higher return for a higher risk private company. That just makes sense. And we'll talk specifically about that and how that impacts the calculation of the cost of capital. Additionally, this cost of capital, expected return on invested capital, is also referred to as the discount rate. The discount rate is what we use when we do discounted cash flow valuations, which we'll talk about next week. The reason I bring this up is the cost of capital is the discount rate. It's not a discount in terms of 100% minus 5%. It's a discount rate that we use to discount future cash flows back to today's present value. And so the discount rate that we come up with, the cost of capital, is used in not just for business planning on an ongoing basis, but also for valuing your company as well as acquisitions. The discounted cash flow methodology, which we'll talk about next week, is the gold standard by which all valuations are measured. Any public company that's sold, it will absolutely have to have a discounted cash flow valuation done. We in the private company arena are many of us are accustomed to, well, it's the best way to value a company is a multiples approach. You take a multiple of earnings times 5, and that's your valuation. Well, that is a suboptimal answer to valuing a company. The optimal answer, the gold standard, is discounted cash flow. So this discount rate / cost of capital takes on a whole new meaning in the context of buying and selling companies. Okay, let's talk about a few key terms as we get into this algorithms and calculation of the cost of capital. First of all, when we refer to the capital structure of a company, we refer to its composition of long-term debt and equity. That is the capital structure of a company. Okay, so to the extent you have a mix of long-term debt and equity, that's your capital structure. And that, in essence, the fair market value of your debt plus the fair market value of your equity is the value of your company. It's not just the value of your equity. It's how much money was used from a debt perspective to finance company plus how much is used from equity to finance company. Those two components on a fair market value basis are the enterprise value of your company. And then you say, well, what about current assets and current liabilities? Well, those are what's called working capital items. And that's a working capital adjustment that may be added to or subtracted from the enterprise value of the company, depending on circumstances, a little bit out of scope for this conversation. So let's move on. And if you could put up slide 1. Kat, if you could put up slide 1. I think we have a poll question coming up, but. Okay, next slide. Okay. So what I want to do is talk about the basic formula for the weighted average cost of capital. In its most simplistic terms, the weighted average cost of capital is the cost of equity times percent equity plus the cost of debt times percent debt of your capital structure times 1 minus the tax rate, because you get an interest rate tax shield. So if your cost of debt is say 5%, but you have a 30% tax rate, then your cost of debt really after tax is lower. It's in the 3% range. So you can understand how that makes sense. But the cost of equity up in that formula, so the weighted average cost of capital, where the cost of equity equals a risk-free rate of return on a risk-free investment, plus a concept called beta, times what's referred to as expected return on a market portfolio, minus the risk-free rate, plus any size premium. Now that's a mouthful right there. So let's back up, and down below, you'll see the risk-free rate. Risk-free rate of return is what you should expect on a 10-year treasury note or 10-year treasury bond. Now, right now, that's running around 1%. But historically, it's been in the 2, 3, 4% range. And so that's what's considered a risk-free rate, because there's a concept in finance that U.S. Treasury, 10-year Treasury is not a risky investment at all. There's zero risk. Now, the expected return on market is what you would expect to get for yield on all public equity securities. And so if you take that expected return on market minus risk-free rate, that's what we refer to as the equity risk premium. So what we're saying is, in order to invest in a risky stock versus a risk-free stock, the difference between those two returns is what we call the expected equity risk premium. But so if you take that times beta, which we'll describe, and beta is a measure of volatility of your stock. Now, in private companies, we don't measure beta. We could, it's a very complicated calculation, but in the public arenas, we do measure beta. So in measuring beta, there are, I'm trying to get this down, this poll question. So there are, in the measurement of beta, there are data houses that calculate and compute companies' beta. The entire set of equity securities traded in the United States, they have normalized the entire group, where a normalized beta of all those combined is a beta of 1. It's a measure of risk. So a measure of 1 means your company is as risky or volatile as all the stocks in the market. So a beta of 1 would be considered normal or good, that you're as risky as the rest of the stock market. Now, if you are less risky or less volatile, your beta would be below 1. But if you are more risky, your beta would be above 1. So the way that we impact the cost of capital for beta is we put it into this formula, but we also do something which we'll describe a little bit later on beta, to take the public company betas, which we can see. So you would compare the companies in your industry and look at what their betas are, which are published. And then that would be used as a measure of using beta for our company. But there are reasons why our small companies will have a beta that differs from the industry. And I'll show how a calculation of that is done in the valuation of small companies, or in a calculation of the discount rate. So in addition to the risk-free rate plus the beta times the market risk premium. There is also a size premium. And when we talk about premiums, we're talking about things that add to the cost of equity. Okay. So in the world of data collection, there are several research groups that collect and track performances of stocks at various levels. And what they do is they break down the market capitalization of all the stocks in the market into 10 categories, where each of the categories has an equal amount of market capitalization that going down. And what happens is, as you move down, the first decile is typically the large cap, S&P 500 type companies. That's the highest decile, decile 1. Decile 10 is the smallest companies in the market. And what we do is we track the returns against these various deciles, and we also track with the valuations of these companies against the deciles. And what you'll find historically is the smallest companies, the smallest decile, the lowest category, the 10%, will typically have a 5 to 6% discount against their cost of capital, because they're considered to be more risky. So actually we call it a premium. So we add a 5 to 6% size premium to the cost of equity. Now, there are other things we add to the cost of equity for small companies. The beta of 1 assumes that all of the global and economic issues are things that impact everybody. Those are called systematic risks. So systematic risk would include, oil prices, world economics, anything that impacts every company in a market is called a systematic risk. But small companies have unsystematic risk. So for instance, let's assume that your company has a management team of father and son, and that's it. Well, that's a different management structure than a Fortune 500 company, obviously. So you would be considered to have potentially a management issue, that you don't have a strong, well-rounded management team. And in the absence of that, you have increased risk. So what we have to do in valuing cost of equity is we have to assess, are there any unsystematic risks that exist? And particularly for buyers are really, really concerned to see what unsystematic risks exist that make my company less valuable, that I'm looking to buy, to make my company less valuable than the market. Because let's say that you have an aging equipment infrastructure. 2 weeks ago, I was with a company and they needed a $3 million piece of equipment, and the owner is 68 years old and said, I'm not interested in spending $3 million. That's somebody else's problem when they buy my company. Well, the problem is it will impact the overall valuation of his company when he goes to sell it, because the buyer is going to recognize the unsystematic risk that his equipment is not up to speed, up to state of the art, and that's an additional cost. So it's going to come against the purchase price at some level. It will be impacted. So we're always looking for unsystematic risks. And if you're a seller, you want to understand what unsystematic risks you may have. Maybe you don't have a full-fledged management team. Maybe your IT infrastructure is weak. Maybe you have heavily reliance on one product or one customer. So you look for those unsystematic risks. And if you're a seller, you're looking to mitigate those as quickly as possible so that by the time you go to market, you have a better company. If you're a buyer, real important to impact your valuation for the unsystematic risk. So make sure that you take heed of that. Now, the cost of debt is easy. Cost of debt is your after-tax interest rate on your senior debt, or the yield to maturity on your bonds if you issued bonds. So that, in a nutshell, this weighted average cost of capital is relatively straightforward. I will tell you this. Recently, I was asked by a pretty significant capital group, the private equity group, to measure their company's expected return against their cost of capital. And so what I did was they had calculated that their cost of equity was 18%. They had already calculated, they said it's 18%, go scrub this company and see if they're going to hit 18%. And the simple truth was, when I went to visit the company and I scrubbed it, there was no chance that this company was going to return 18% to equity holders. So the private equity group, capital group that I was working with had a decision to make. The company was looking for an additional infusion of $7 million. And what I had to tell them, unfortunately, was that the company that they had invested already $10 million into was not able to produce an 18% return on equity after servicing the debt. And so they closed the company down. And so that in a nutshell should tell you how important the cost of equity is. And if you are in a company and you don't believe there's a cost of equity because you don't have to write a check for it, I can tell you in the public arena, when the equity expectations of shareholders are not met, we hear about the proxy fights, we hear about CEOs getting fired, we hear about shareholder raiders coming in, upsetting the apple cart. It is a very real thing, even though it's not something that you can put your hands on. It's a calculation of what people expect to return for having their investment in a company and what they expect to get every single year. So let's go to the next slide. So I want to go through a sort of an example of how this. Okay, so here's a high versus low weighted average cost of capital example. And I think that this is illustrative of several points that I'd like to make. So let's assume that you have, I'm trying to move my poll questions around here. So, okay, let's assume that you have Company A and Company Z. Company A is a larger company, more robust, tighter company. Company Z is a small company, but they have the same percent debt in their capital structure. And because Company A is a stronger company, they can borrow money a little cheaper. They have the same tax rate. So their after-tax cost of debt is a little different. Their percent of equity is the same, but the expected return on market, that's on the market portfolio. That's on all the stocks in the market. That's the rate that you could get if you invested reasonably, if you invested in long-term hold investment in the stock market equities. So that's the same for both companies because it's not company specific here. But then you have a size premium of 6% because if you go through the deciles and you can find my Company Z is so much smaller than Company A that it falls into the 10th decile, and there's a premium of 6% that we should add to the cost of capital because it's smaller. And historically, companies that were that much smaller than the industry leaders were valued at a level that's so much less that it would cause you to impact the cost of capital for 6 points. Then you have an unsystematic risk premium for your Company Z because you have a 35-year CEO and no strong management team behind him or her. So the risk-free rate's the same. I used a risk-free rate as about 6 months ago. Now, your beta is going to be higher. And we calculated beta. I didn't show you how I did it, but essentially, there's an adjustment that gets made to beta because of the just the differences. Our company's returns have been far different than the industry returns, and the Company A returns have been much closer to the returns. And so you end up with a cost of equity of 14% for Company A and 35% for Company B. So what you're saying is, Company Z, if you're an equity holder or you're the owner and you've invested money, you should expect a 35% return on investment every year. And you say, well, that's outlandish. That's ridiculous. Nobody expects that. That is not true. That is not true. Private venture capitalists and many private equity firms, they're looking for 25%, 30%. Venture capitalists are looking for 50 to 60% because 2 out of 3 investments fail. So it's not unusual to see a cost of equity in the 30% range. So then when you look at the cost of capital for Company Z is almost twice as much. So now let's assume the same capital structure for an $8 million enterprise, so to speak. And so everything looks the same, except the annual free cash flow is the same. Now the annual debt service is lower for the Company A versus Company Z because of lower interest rate. And then what's left is return on equity. So the return on equity for Company A is 39%, and you return $780,000, but the expected return on equity is $282,000. So you're pretty happy in Company A. Company Z, you just barely get by. So you've met your expected cost of capital and you have an excess of $38,000, but you're right on the cusp of not making it. Okay, so let's move over to the next slide and let's change a couple of things and show you how this can impact your company. So these companies have two different capital structures. Company A has 75% debt and Company Z has 60%. Maybe Company Z is not as investable because they don't have as strong a company and the banks aren't as willing to lend. You have a similar cost of debt differential, 4% versus 5%. Your percent equity, of course, is dependent upon a percent of debt equity. So anyway, you get down here and your cost of capital is 14 versus 35. You keep moving down. And so you both have $8 million of debt and equity, and you have the same cash flow, except your return on equity in Company A is 780,000, and you're expected 282. Your return on equity in Company Z is 902,000, but you expected $1.1 million. You have a $241,000 shortfall. Now, that is a problem, and that's a problem not just for the owner, but it's a bigger problem for the other non-operating equity holders who may be concerned that, we're not hitting our numbers, we're not getting where we need to be. So it's a very real problem. And if this were to happen in a public company, and it does all the time, heads are going to roll. So it's important to understand how these differences can impact the cost of capital and how your capital structure can impact it. So you say, well, what can I do? Well, if you feel like you have if your capital structure is not close to what the industry typically looks like, you might want to consider changing that. You could do that through, let's say that you have more equity than the typical bear. So you would add maybe more debt to your capital structure, or maybe you have more debt and you need more equity. You'd go find equity holders, but you don't sit still and say, well, we didn't meet our cost of capital. We're short almost $250,000. Oh, well. This has very real impacts in a very real marketplace. Let's go to the next slide. We'll try to go to the next slide. Maybe having a technical difficulty. Okay. Whoop, we had it. It was there. Okay, great. Whoop. All right. Now this is from a real valuation, a real project we were working on. And so this was about in the, I want to say early spring and maybe January, February. It might have been the fall. Anyway, these numbers were taken. We subscribe to Duff & Phelps, which provides an online tool to provide you with this information. So the risk-free rate of return from the cost of equity, 1.66. That's pulled directly from Duff & Phelps database where they're tracking the risk-free rate of return. The long-term equity risk premium. Now, in the previous example, we showed a long-term equity risk premium of 12% minus maybe 1 or 2%. But typically, over the last, really 50, 75 years, the long-term equity risk premium over the risk-free rate has been in the 6 to 7.5% range. So investors have routinely sought out 7% to 7.5% more for an equity investment than they would want for a risk-free investment. So and that number is dynamic and continues to move all over the place. But in the first column with premium, this is our target company. This is the company we were valuing. Without the premium is the industry norm. And what you'll see is that the beta adjusted equity risk premium is almost 15% for our company versus without the premium, it's 7%. And then there's a size premium. Now, earlier when I talked about deciles, there are different size companies. The 10th decile, they've realized, these people that collect this data, has been broken into an A and a B, and then an X and a Y. So they've broken it down further into further smaller size companies. Well, for our size company, the size premium, meaning the amount by which you have to increase the cost of capital to match what the market has done, is almost 11%. size premium. So when you add those together, the beta adjusted equity risk premium and the risk-free rate and the size premium, you get a 28% cost of capital. Now, this is a very real example. We were doing a buyout of a company, and in the context of that company buyout, we presented this to the management team of the seller, and they understood it, I think. But the long and short of it is, if you were going to invest in this company as an equity holder, you should want to get $28 for every $100 you invested every year. Now, we added in the tax rate to come up with after tax debt. And then we look at the capital structure. A debt to equity ratio of 3 means you've borrowed 3/4 of the capital structure. So you borrowed 3 parts debt, 1 part equity. So that would imply a 25% equity investment and a 75% debt investment. Now, the market, the industry, and this was based on, we took about 8 companies in the industry that were the large market leaders, publicly held, and the average debt to equity ratio was 0.67, meaning more equity than debt. That's not uncommon in the public companies, because debt equity is so much easier to access when you're a public company. That's the whole point. But what that means is your overall weighted average cost of capital for our company was 9%, and it was just under 6.5% for the market, for the peer group, the industry leaders, which means it's a 30% discount. Our company would sell at a 29.78% discount versus what it would sell at if it were an industry leader. So it's not uncommon to see a 30-40% discount here. It's called implied premium. It's a premium to the discount rate. So it increases the discount rate. And if you discount back at a higher rate, you're going to get a lower number. I know that's a little hard to think through, but I've said it. And if you remember the present value calculations, it should make sense. I'll say it again. So the additional premium is added to the discount rate, and the discount rate is used to calculate the present value. So you take the cash flow divided by 1 plus the discount rate, and then you discount that back. So now let me get into the whole discussion about beta and how beta changes. So you'll see the industry beta of 0.98. Again, I told you that the beta of all industries, all stocks in the market, is normalized to 1. So this particular industry has a beta of 0.98. So it's very, very in line with the rest of the market. So you do what's called unlevering and relevering beta. Now, here's what we're doing. When a company's beta is measured and the volatility is measured of earnings, what happens is that's assuming that whatever the debt is on the company's books in the aggregate, it takes into account that whatever the beta is measured at, that's including whatever the debt to equity ratio is in the industry. But if you take your company and you say, well, we have a very different debt to equity structure, you need to change the beta, because when you're borrowing money, you have debt service, right? So if you go to a higher level of leverage, you're considering that you're adding risk to your company. More leverage means more cash flow out, more debt service, right? Now, you think about that, and if you change the debt to equity structure, which we've done here, our company, we started with a debt to equity ratio, or a beta, of 0.98 for the industry. When we unlever it and relever it with our capital structure, much more debt laden, much higher leverage, that down at the bottom right corner of this slide, you'll see levered beta is 2.1. Actually, it's 2.09, and you'll see that same number appears up in the column that says with premium, third line down, industry beta. That's the industry beta, but we've adjusted it for our new capital structure. And so what that does, it has a multiplier effect on the long-term equity risk premium above. So you take that 7.15%, which is the long-term equity risk premium, but to invest in this risky of a company, you really want 15% instead of 7%, and then you add in the size premium, and that's how you get to 27.51. So this is obviously a very complex set of calculations, but this is how valuations are done, and this is how you determine what your discount rate is, so that you understand, what you need to target from a budgeting perspective, and if you're a buyer of a company, what you need to build to so that you can use a proper discount rate and not just pick a number and use the industry, because small companies have very different risk profiles than do large ones, and we all know that. But this is how we calculate it, and it's, to some of us it's Greek. I teach this stuff, and again, this would probably be 3 sessions in an M&A class where people are already geared up and already sort of thinking about these economic theories, but it's very real. So what I would ask at this point, if there are any questions. I've not seen any questions in the chat box, and I'm not sure I have a chat box on my screen. Do we have anything? Okay, let me pull that up. Okay. How am I calculating the implied premium? The implied premium is, if you go back to that slide, it's the difference. Okay. How do I calculate the implied premium? Can we go back to the slides? Okay, so we take the difference by which the 6.35 and the 9.04 are calculated. So the difference between those two is 29.78%. It's so let me, so it's 0.35. So if you divide, I think if you divide the 6.35 by the 9.04, the difference, and subtract that from 1, you'll get the 29.78. Okay, so what we're saying is, to the extent a company would have a 6.35% cost of capital, ours is 30% higher, and it's 9.04. So, and we'll talk about this next week, but what's interesting about that is when people use multiples and they look at the multiples approach for valuing business, they say, well, the public, big public companies are selling at 7 times. Well, the big public companies are selling at 7 times, but that 7 times multiple doesn't apply to small companies because we have this implied premium that needs to be added to it, which is very real. Okay. Let's see. What about the unsystematic risk premium again? Okay. So the unsystematic risk premium is, earlier in the first session, we talked about things that cause that attributes to high value companies. Let me say it this way. If your company is subjected to fuel prices, changing weather patterns, global economics, wars, elections, those are systematic risks. Every company is impacted one way or another from those things. Unsystematic risk are things that your company has they're specific to your company. And I don't want to be negative in talking about this because I know we've got a lot of business owners here, but if you don't have a really strong management team, for instance, so it's not uncommon in small businesses, like the business I was with 2 weeks ago, where they did not invest in new equipment, and so they were at least 1 generation behind in their technology. And the management team was a father and son, and the father was retiring. So they had nobody else in the company who had a manager title, and this was a $15 million revenue company. The problem with it is they were good operationally, but when the father retires, they didn't have anybody in training. In the absence of that you won't find that in a large public company. I mean, you might find a few holes in your org chart, but you're not going to find a significant management shortfall. And maybe you have a situation where the company is borrowing 90% of its capital structure. That changes the dynamic versus a public company. Maybe you have a product set that is not being refreshed. It's not uncommon, unfortunately, to see owners who are near retirement age bleed a company out, meaning I'm not going to put any more money in research and development. I'm not going to come out with new services. Let's just continue to sell what we sell. And in 2 or 3 years, I'm retiring. I'm going to take my cash and run. The problem is you're going to take a lot less cash at sale time if you just take the money and run, because you have not kept it current and you're going to be penalized for that. So unsystematic risks, how we calculate the premium, the simple reality is it's analyst estimate. You have to do this for a while, and this is why valuations are so dicey. You get 10 people doing a valuation, and you may have 9 different valuations because people apply different rates to different things. So I'll give you an example of an unsystematic risk that really threw a monkey wrench into one of our clients. This client was successful. They were doing like 10 million a year revenue and about $3 million a year in EBITDA. So very high value company. And it looked, it was consistent, been around for about 22 years. The founder was still there. He was young. He was in his early 50s, except 80% of their revenues came from one national customer. Now, the question is, if that customer goes away, what's left? Well, the answer to that is pretty much nothing, right? You've got 40 professionals, an intellectual property marketing company. If you take that one customer away, the company's gone. So that's an unsystematic risk. You won't find large public companies having that risk. They just won't allow it. And if they do, they're going to underperform or have risk of underperforming, and the shareholders will revolt and it will remedy itself. But in a small private company, that can happen. So I was challenged by the owner to come up with a valuation. And, to me, that was a huge unsystematic risk that, to me, it doubled or even tripled his cost of equity capital. And I reviewed my analysis with a couple of other valuation experts in our firm, and their views were slightly less pessimistic. But my point of view was, from the buyer's side, how willing would you be to buy that company knowing that one customer could sink you? And it's not unthinkable that after 25 years, particularly if the founder of the company retires, that the loyalty to that company from the customer might go with them. So it's not an inconsequential issue. And one of our experts and myself at the same firm, we had a difference of opinion about how much to impact the cost of equity for. It comes down to your level of risk assessment. If you go along, get along, and you think, well, it's okay, fine. But I've seen way too many examples where a customer decides to walk away with little notice, and the company has 25% of the revenues to that customer, and the company's not prepared. That is a huge unsystematic risk that should be accounted for in evaluation. Now, in that case, I viewed that company as almost not sellable, other than to a large strategic company that would have the wherewithal to tuck their $10 million revenue in as an individual specific industry product line for that particular customer and merge it into a several $100 million revenue company. That makes sense, because you could say, well, it's just a project. It's not its own standalone company. But to buy that company and not impact it with a heavy unsystematic risk premium is, I think it's bad decision making. So how do I arrive at a number calculation for the unsystematic risk premium, given what you just described about what it includes? Well, when we do valuations, we ask a lot of questions about the company. There's a lot of quantitative information, but there's also a lot of qualitative information. What is the strength of the management team? Do you have a board? How often do you run your financial statements? Do you have outside oversight over your financial statements? Your internal control environment. We run an assessment of customer diversification. We look at growth and trends, and we stack up our companies, benchmark them versus the industry. So we identify things that look askew. So currently I'm working on a situation where CEO makes more money than the entire rest of the team in a company. And this is a company of 15 people. Well, that's an odd situation. That's not standard. So we would go back and change some numbers for that, but that wouldn't necessarily be an unsystematic risk, but we certainly do have to look at qualitative information and make decisions about whether the company has risk that we don't see. So we will walk the site, look at the equipment, understand if it's current or it's not current. And it's I think this isn't going to sound great, but it's the truth. The more you do something, the better you get at assessing these things. And it's just like business owners that are on this call. The longer you're at it, the smarter you get at it. The same thing is true of assessing unsystematic risk. We go through a very rigorous questionnaire with our clients and doing valuations to understand not just the things that show up in the numbers, but the things that don't show up in the numbers, like strength of management team, employee turnover. So that provokes my thinking. So I was working with a company and they were turning over 40% of their people every year. Well, that's an unsystematic risk. Most companies aren't doing that. So to me, they had an undertrained, underskilled staff, and they also had some sort of environmental issue inside the culture of the company that caused it to be not a happy place to work. And so when you look at that, you know a company like that will underperform relative to its peer group, and you also know it's more risky. So what do? You apply do you apply a premium to that or not? Other unsystematic risk, which again, it's feel. It's like I'm a cyclist, and back in 1800s, 1900s, early, when people were starting to ride bicycles, they would tighten up a bicycle wheel using the spokes, and they would ping the spokes like tuning a piano. And you had these masters over in Europe who could tell by the ping, the sound, how if the spokes were tightened properly. It's similar in this business of coming up with the unsystematic risk. Is that a good number, or is that not a good number? So other unsystematic risks would be things like maybe a very complex manufacturing process, way more complicated. You figured out how to do something that nobody else is really doing. You created your own equipment and you have a one-of-a-kind process. Well, your ability to replicate that process, your ability to expand that process to a bigger customer set, is that the same risk that everybody else runs in the market? Probably not. So you've created your own victory to some extent by having created your own mousetrap. But is that repeatable? Is that something that the new owner can come in and take over, maintain, manage that equipment? And we see that. It's like, well, look what we built. Well, you built it, but next generation of people didn't build it. They're not going to know necessarily. And the same thing is true of accounting systems and financial management systems and other leadership issues. Okay, so what other questions? Okay, so we're at about 48 minutes. So where would intellectual property be valued? That is a whole different kettle of fish. Intellectual property, the way we would value it is to look at when it's deployed, when intellectual property is deployed in some management skill set, what are the future cash flows that company can generate? So if I have intellectual property, which is I can make let's just say I can make a product that doesn't exist using lasers, and I'm the only one in the market that knows how to do it. Well, you would value that intellectual property based on the future cash flows that are generated from it. And that gets into next week's assessment. But essentially you're saying, okay, I've got this better mousetrap knowledge, or maybe it's a software system, and whatever it's gonna, once I go to market, I take all my costs against it, all my revenues against it. What cash flows am I going to generate over the foreseeable horizon, and discount that back at your cost of capital, 1 plus your cost of capital, and that will tell you what that intellectual property is worth. And you know, that's where it gets real. You know, that's where you're thinking, wow, am I really buying into these theories? And the answer is that you should. The answer is that, you know, not applying these types of discounts and not applying this type of thinking, particularly looking forward at cash flows. What happened yesterday is important to the seller, but what happens tomorrow is important to the buyer. And as the seller, if you're not focused on the future and you're not willing to bet on the future, then, you know, you're going to get discounted. That's all there is to it. Okay. Okay. Last question. Okay. I think we got that. Do you use the same formulas for valuing a service company as a products company? Yes. Yes, you do. Now, within the services arena, it's more where you get into the valuation differences is valuing the pro forma. You're putting a pro forma together, and you're running it through your income statement, balance sheet. And in a services company, you're looking at you know, you're not selling products. You don't have, your balance sheet's not as strong. You don't probably have the same equipment, plant equipment, so you don't have many hard assets. What happens in a services company is you generally have a very much lower debt to equity ratio because you don't have collateral to borrow against. So that will impact, you're going to have a more higher composition of equity in a services company in order to finance it. So, you know, more equity, and equity's higher cost than debt. So chances are services companies are going to be, they will look less valuable than a products company potentially because of the higher cost of equity. But we can I'll add an example of that to next week's session. What are the biggest systemic risks I see? Well, I would think that the pandemic is certainly, so, you know, it's really thrown a monkey wrench into a lot of deals we're working with. The pandemic, but also the downstream impacts of things like the PPP loan program and subsidies and what's going to happen to interest rates. I think the climate and the pandemic are the two biggest things to worry about right now. That's my opinion. What are the biggest systemic risks? Okay. Did I see David's question? Where would intellectual question be valued? Yeah, I did. I already talked about intellectual property. You would do intellectual property would be valued using the same formulas and the same metrics, essentially the same algorithms as a products-based company. So, what's the value of a strong company culture? The number one reason why acquisitions fail is culture. And how do you value that? Well, to me, that's a binary. It's a yes or no. It's not really an unsystematic risk. I don't know if I used this example in an earlier session, but when I was in a public company, we went to a software company, and the guys were all running around in gym shoes and cutoffs, and they worked whatever hours they wanted. It was swing shifts. People were working 12 to 8 in the morning, whatever. We're all buttoned up and wearing suits. And that was the culture of that company was so different than the culture of our company that no matter what the price, it wasn't a deal worth doing. I would say if the company culture is that much askew, my recommendation is don't do the deal. I don't even think it enters into the overall cost of capital because it's too big of an issue. It's bigger than anything we've talked about so far today. So are there any other questions? Okay, so next week, what we're going to do is go through the valuation methodologies. Next week will be perhaps the most meaty session. It's all predicated though on understanding this cost of capital that we talked about today. Next week, we'll go through the different methodologies. The methodologies we use. We use a dividend growth model, which essentially assumes there's a constant dividend that's paid, and we impact that by the cost of capital, and that gives us valuation. We use a discounted cash flow valuation method, which is the gold standard. We do the multiples method, and then we'll talk about some other methods. So next week will be, hopefully that's the reason that you are attending this class, is to understand straight up valuation methods and how they work. And so this recording will be available and the link for next week's will be available within 48 hours. So I think it would be, if you want to attend next week's session, the link will be out within a couple of days. And we will have recordings available. We had a glitch with the first session, and we have to re-record it, but the second session should be out there already. And this third session will be out within 2 days. So it's barnesdenning.com on-demand events is where you'll find it. Does that answer your question, Jim? On-demand events, barnesdenning.com. So I hope you found this helpful. I hope you found it interesting. Clearly, we're available. I'm available to answer any further questions, explain any more of this. To me, this is the whole process we're going through is just to refresh a lot of your recollections. You went through this. When I talk to people and look to hire people, even experienced controllers and CFOs, I show them evaluation methodologies. I show them this cost of capital thing. And many responses I get are, I remember it from college. Well, that's fair. There's a lot of things I remember from college too that I don't do every day. And I don't feel badly that I don't exercise that skill set. But this is pretty heady stuff. Okay, so can I go through the unlevered beta calculation versus levered beta? Okay. It's a very complex calculation. I think what I'll do is I almost put a slide in the deck. What I'll do is I will put a slide in the deck that we distribute, if you want to see the slides, that has that calculation. It's built into the models that I put out there. But I don't really think I can go, well, let me just say this, okay? So you're starting with a levered beta already of your company. And so what you have to do is unlever that beta to assume that there's no debt on the books, and then impact it for the levering up of your specific company beta, okay? So I think it's just too complicated. I'll put it out there. I'll put the formula out there. And if you specifically want to see it before I put it out in our deck, email me directly, dlucarelli@barnesdennig.com. And, this is something that not a lot of companies do and not a lot of valuation analysts do, is unlevering and relevering beta. But if you do have a capital structure that varies significantly from the peer group of public companies you're using, you're fooling yourself to think that you don't have more risk if you take on more debt than the public companies have. You're fooling yourself. And if you're a buyer, you're going to overvalue the company, and that's not a good thing. So any other questions? Thank you again. We'll be on next week at 1:30. Appreciate everyone's interest, and I hope you're finding this valuable. Please feel free to email me or call me if you want to add anything to next week's class, or if there are any specific questions you have, I'm happy to answer live and in person.